Law of large numbers and risk spreading insurance exam prep. Question 1. What principle states that larger groups provide more accurate predictions of future losses? Morbidity table. Independence. Expected loss. Law of large numbers. The law of large numbers is the foundation of insurance predictability. Question 2. What term describes risks that share similar characteristics and risk profiles? Actuary. Exposure unit. Homogeneous exposure. Mass of exposures. Insurers need homogeneous, similar, exposures to accurately predict losses. Question 3. Using past data to forecast future claims is called what? Mortality table. Underwriting. Credibility of data. Statistical prediction. Statistical prediction relies on historical data and the law of large numbers. Question 4. What is the basic unit of risk used to calculate insurance premiums? Exposure unit. Probability. Pooling. Risk spreading. An exposure unit is the metric used to measure the risk assumed by the insurer. Question 5. Which professional is responsible for analyzing data and setting insurance rates? Credibility of data. Underwriting. Probability. Actuary. Actuaries use mathematics, statistics, and financial theory to assess risk in price policies. Question 6. What statistical tool predicts the rate of death in a specific population? Sample size. Underwriting. Premium calculation. Mortality table. Mortality tables are essential for pricing life insurance policies. Question 7. What statistical tool predicts the rate of illness or disability in a population? Pooling. Statistical prediction. Morbidity table. Mortality table. Morbidity tables are used to price health and disability insurance. Question 8. Increasing what factor makes statistical predictions more accurate? Actual loss. Expected loss. Credibility of data. Sample size. A larger sample size reduces the margin of error in predicting future losses. Question 9. Distributing the financial impact of a few losses among many participants is known as what? Expected loss. Risk spreading. Statistical prediction. Credibility of data. Risk spreading ensures no single entity bears the full brunt of a catastrophic loss. Question 10. The process of determining the appropriate price for an insurance policy is called what? Exposure unit. Rate making. Sample size. Probability. Rate making uses actuarial data to ensure premiums cover expected losses and expenses. Question 11. What term describes the reliability and trustworthiness of statistical data? Credibility of data. Statistical prediction. Mortality table. Homogeneous exposure. Data credibility increases as the size of the exposure pool grows. Question 12. For predictions to be accurate, individual risks in a pool must possess what characteristic? Independence. Expected loss. Underwriting. Exposure unit. Independence means a loss experienced by one unit does not guarantee a loss for others. Question 13. What represents the insurer's estimated claims based on statistical modeling? Risk spreading. Deviation. Expected loss. Actual loss. The expected loss is the anticipated payout calculated by actuaries. Question 14. What represents the real claims an insurer ends up paying out? Mass of exposures. Credibility of data. Risk spreading. Actual loss. Actual loss is the true dollar amount paid, which insurers compare against expected loss. Question 15. What term refers to a large volume of similar risks combined together? Law of large numbers. Underwriting. Risk spreading. Mass of exposures. A mass of exposures is required for the law of large numbers to function effectively. Question 16. What mathematical concept expresses the likelihood of a specific event occurring? Probability, risk spreading, expected loss, deviation. Probability determines the chance of a loss happening within the risk pool. Question 17. What measures the difference between expected losses and actual losses? Deviation, underwriting, expected loss, statistical prediction. Deviation decreases as the number of exposures increases, making outcomes more predictable. Question 18. What is the practice of combining risks to share the financial burden of losses? Pooling, mortality table, credibility of data, exposure unit. Pooling allows the premiums of the many to pay for the losses of the few. Question 19. What process filters applicants to ensure they fit the homogeneous pool being priced? Rate making, premium calculation, underwriting, homogeneous exposure. Underwriting evaluates applicants to maintain a balanced and predictable risk pool. Question 20. What is the ultimate goal of applying the law of large numbers in insurance? Risk spreading, premium calculation, independence, exposure unit. Accurate prediction allows for exact premium calculation that is fair and sufficient.